walk around the column. Yeah.
I'm gonna pull this right here.
Want to be brief. I'm going to pray for our time together, and we're going to get started. If you will, bow your heads. Dear Heavenly Father, we come to you, want to give you thanks. We want to thank you for bringing us to this moment to learn about stewarding the resources that you have given us. Lord, I pray for the instructors on tonight, that they are clear. Lord, I pray for receptive ears, more importantly, responsive lives with what you have provided for your people. Lord, we do this in all for the glory of you and your kingdom. In Jesus' name I pray. Amen.
Amen. All right. All right, I think I'm already hot. Can you guys hear me okay? Hear me just fine? Okay. All right, cool. All right, so I'm hearing some feedback a little bit. Yeah. Keep talking? All right, okay. All right, so thank you all for coming out. I'm Marcus. I've been with Arvest Bank now for about 15 years, so, but I've been banking for about 41 years. Long time. So we'll go ahead and get started. Hopefully some others will come in and join us. But tonight, we're going to talk about your credit score, understanding your credit, all the things that you need to know about credit. Then we'll, so I've got a PowerPoint presentation. We'll kind of glide through pretty quickly. But I want to leave a lot of time for questions at the end. So with that, we'll go ahead and get started. But before we get started, we always like to check and see how everybody's doing. So we have this saying around here. It's like, how's the family? I'll say, how's the family? And you guys say the family's good. So, all right, how's the family? Family's good. All right. So let's go ahead and jump right into it here. So Arvest Bank wants you to know about your credit report. We want to make sure that you understand how it's used and how maintaining a good credit score is important, and how to maintain a good rating. Obviously, when you have the higher your credit score, the easier it is to obtain loans and obtain loans at a favorable interest rate. So the interest rate can vary depending on what your credit score is. So we'll get into the credit score numbers a little bit later. But obviously, Arvest Bank, as a financial institution, will be glad to discuss any financial services with you or solutions with you, and be happy to sit down with you at any one of our branches around the city and around what we call our Little Rock footprint, which is Little Rock, Conway, Morrilton, Hot Springs, Sherwood, Jacksonville, Cabot, Benton, Bryant, Hot Springs. So any of those offices there will be happy to discuss financial solutions with you. So, but we're not credit counselors, so I have to underscore that the opinions that will be expressed tonight are mine. They're not Arvest Bank's, and because we're not counselors or credit counselors or advisors, we are just sharing with you some things that we've seen over the years that have worked for others, that have worked for us, and so we're sharing this information with you. All right, so let's just jump right into it. What is a credit bureau? So basically, it's a company that collects information on your payment history, your credit worthiness, and then those companies share that information with financial institutions, credit card companies, insurance companies, apartment complexes. So if you want to rent an apartment, generally they'll pull a credit report on you. If you want to buy a new car, banks will pull a credit report on you to see how you have paid your bills in the past. So basically, it's just a company that collects information on you and how you pay your bills. So that's really all a credit bureau is. There are three main ones. There's TransUnion, Experian, and Equifax. We'll get into a little bit about that a little bit later. So with that being said, we want to make sure that you understand how to read a credit report And so for those that are online, we have uploaded a copy of this PowerPoint presentation along with a sample credit report and also a sample letter, what we call a dispute letter. So if you have something on your credit report that is not accurate, that's wrong, or that needs to be corrected, then there's a letter also that we've uploaded online at smark.org. So you can take a look at those and print those at your leisure. Okay, so let's get into the actual credit report. Some things that you need to know. So at the very top of your credit report is your personal information. So this is very important because things like addresses, your name, the correct spelling of your name, your correct address, your current address, city, state, all those things, your current employer, all those things make a difference because what happens now with identity theft, if I'm trying to steal someone's identity, typically what I'll do is I'll go apply for credit in your name using all of your credentials, but I'm going to send the information to some other address. Because if I send it to you, I'm going to tip you off that I'm trying to steal your identity. So the address is very, very important because this could be simply a mistake, or it could give you an indication that someone is trying to steal your identity. So it's very, very important that you make sure that the address is accurate. Okay, next up, public records. So this is information that is derogatory generally, that is filed on your credit report, collections, charge-offs, bankruptcies, things like that. These are all things that are that negatively affect your credit score. So we want to make sure that none of these items appear. And if they do show up on your credit report, then you want to make sure that you take the steps to try to correct these things because it will drag your credit score down significantly. So you want to make sure that anything like a civil judgment, a tax lien, where someone's trying to litigate or sue you, you want to make sure that none of those things are showing up here because, again, it really pulls down your credit score. And then adverse accounts, again, we talked about a little bit about collections. So when typically as a bank, when we make loans to customers and they don't pay us back, typically what we'll do is we'll try to make arrangements with them to make payments, but sometimes, they can't for some reason. Maybe they've had some financial hardship. And so collections are inevitable where the bank is going to say, okay, we understand you're having trouble now, but we're going to put this collection on your credit report so that if you try to get credit someplace else, once you are back on firm ground, the bank wants to be paid. That's all the bank wants is a return of their principal plus interest. So typically banks will put a collection out there if there's monies owed. Fairly easy to correct, by just taking care of those collection items and then writing a letter to the credit bureau to have that removed, submit your documentation that you paid the outstanding debts, and typically those are not too terribly hard to remove. So that's that. And so I start talking sometimes, and I just get going. So if you guys have questions, I'm going to pause for just a second. Questions? Yes, sir.
A quick one. How big are the credit bureaus? I'm asking because you are saying I submit my...
We're going to bring a microphone to you. Sorry. Go ahead.
Yes, thank you. How big are credit bureaus in the staffing? You are saying I should send my letter there. Is it likely to be answered out of millions of letters? Right.
So credit bureaus are large, and so they have 30 days to answer your letter. You're right. They're large organizations, but they do this all the time, and so by law they have to answer you within a certain amount of time. So feel free to send the letter. They are once they receive it, they are on the clock to give you an answer. And typically, if they don't answer you, then they have to remove the information off of your credit report. So, but they do this all the time, and I wouldn't worry about the time delay or the backlog because these companies are large and they do this all the time. Okay, you bet. Any other questions? Everybody good? Okay? All right. So let's talk about some of the things that are good on your credit report. So obviously, when you pay on time, there's a record of how you pay. In this example, you see 2016, 17, and 18 just as a sample period to give you an idea of how it might appear on your credit report. Now, I have to pause and say that every credit bureau has a report that looks a little bit different than the other. So it's not that every credit report is going to look like this. Okay, so it'll be some resemblance of this, but it may not be exact. But when you see okay, that means that you paid on time or paid as agreed. If there's an X there, it means that there was no report for that particular month. So let me pause for a second and say that every credit bureau doesn't, or every company that you pay is not required to report to the credit bureau. So you may come across some of these automobile dealerships, for example, where you can buy there and pay there. So they're not obligated to report your payments to the credit bureau. They should, and you have the right to ask because you want to get credit for every payment that you make on time. But just know that every company that extends credit to you is not obligated to submit your payment record to the credit bureau. So it's very important because every payment that you make on time, what we call good payments, you want to make sure that you're getting credit for every good payment that you make because payments that are made on time will improve your credit score over time, okay? So satisfactory accounts are paid as agreed, or as we call it, paid on time. So I'd like to pause for another second and give you the bank's definition of paying on time. The bank's definition of paying on time is paying on or before the due date. I know that's weird, isn't it? Who pays their bills early? I know. On or before the due date, okay? Question? Oh, never mind. I thought you had a question. All right. Kind of like an auction, you know, you raise your hand, you might buy something. No. All right, so on or before the due date is the bank's definition of paying on time that ensures that you're never late. Other options are things like automatic debit. So if you want to have your payments come out of your checking account or savings account automatically, the bank can set that up on what we call auto debit or auto pay so that on the due date, it's paid every month on the due date. On the due date. Now, if the due date falls on a Saturday or Sunday, it may maybe pull a day before or a day after, but around the same time, that ensures that you are never late, and those timely payments will help improve your credit score. So satisfactory payments are important. They increase your credit score, and so again, there's a sample credit report on the website that we've uploaded. That you can take a look at, and we're happy to answer any questions about it. If not in this session, the next session, we'll be happy to answer questions. All right, so we talked about, you know, things that adversely impact your credit score. We talked about things that positively impact your credit score. Let's talk about inquiries. So this is a question that we get pretty often, and basically, there are two types of inquiries. So there are hard credit pulls and soft credit pulls. And basically, the hard pulls are when you apply for credit, where you physically sign your name and say it's okay for you to pull credit, Mr. or Mrs. Creditor. It could be an automobile dealership, it could be a mortgage company, it could be someone, a credit card company, someone who is extending credit or you're requesting credit from, formally requesting credit from, and you sign something that says, I'm authorizing you to pull my credit report. That's a hard pull. So hard pulls do impact your credit score if you have too many of them. And I'll talk a little bit about why here in just a second. The second type is a soft pull. And these are primarily companies who might look at your credit profile for the benefit of offering you some type of pre-approved, it's not really pre-approved, but some type of credit card offer where they think you are a good candidate. Now, you still have to sign and apply, but they screen these customers through these soft pulls to see if you are a good candidate for a credit card or some other type of an offer. So that's a soft pull. Soft pulls do not impact your credit score because you didn't physically sign something that says, hey, I'm authorizing you to pull my credit report. So hard pulls, you authorize someone to physically pull your credit report because typically you are applying for some type of credit. Soft pull is when someone is screening you for some type of an offer so that you can apply. So credit card companies do the soft pulls all the time, and that's primarily where you'll see those soft inquiries show up and why. Okay? Okay, now let's get into the meat of it here. So what's a good credit score? So 800 plus is a good credit score. If you've got an 800 credit score, you're in the exceptional category. You're doing everything that you should be doing. You've got a good payment history. You've got a good payment record. You've got a good mix of credit. So you might have some installment. You might have some revolving credits. And we'll talk a little bit about that here in just a second. But if you have a credit score of 800 or higher, then you are demonstrating to lenders that you're a good credit risk. So if you have a credit score that's 800 or higher, you can pat yourself on the back or stand and we'll allow you to take a bow. I'm just kidding. But that's good. That's good. 800 is really good. So the highest credit score is 850. So I've seen, actually I was talking with someone last week that had an 835 credit score. So it's possible. Yeah, it is possible. We'll share some tips with you on how you can get there too. So, all right. So 740 to 799 is very good. Still not the highest, but that's a good score. If you got a 799 score, 775, those are still good scores. You can borrow at generally the cheapest interest rates, and banks would generally consider you a really good risk, dependable borrower, someone who's going to pay back everything that you borrow. So 740 to 799 is very good. It's above the average of most consumers. So again, if you got 750, 740 or higher, you're really in the upper echelon of individuals who have a good credit score. So really good there. 670 to 739, still good. Not the best, but still not bad. Actually, it's you're really in the category where the average borrowers land if you're in this 670 to 739. So 580 to 699 is fair, and below 580 is what we consider we got a little bit of work to do. We don't call it poor, we just say we have a little bit of work to do. And for those of you who might be asking, what is the bank's minimum? So banks have different minimum scores. So our bank, Arvest Bank, is 640. So if you have a credit score that's below 640, we tend to want to do a little bit of work with you and help you get your credit score a little higher. Now, it doesn't mean that you can't still get a loan if your credit score is below 640. It's just Arvest Bank's minimum score is 640. We have some other options where we can still get you financed. It might just be at a little bit higher rate or much higher rate to help offset the risk. So, all right. Questions about the credit score ranges? So again, 800, exceptional. You're in that 700 range, very good, above average. And 670, 739, still good. 580 to 669, fair. Got a little bit of work to do once you get below 640, but still not the end of the world. And we'll talk about some of these percentages on the other side here in just a second. Questions about the ranges? Okay, so there's a handout on your tables there. So it talks about what makes up a credit score. So when you look at the credit score, you'll see 35% of what makes up your credit score. The impact is 35% on a scale of 0 to 100. 35% of the weighting of your credit score is what I talked about, making those payments on or before the due date. So those things matter. Those payments, they really do matter. So making those payments on time and or setting up the auto debit, as we talked about before, is going to be the way to go. That's going to help you improve your credit score and also maintain a good credit score. So that's the heaviest weighting on this page when you look at it. Payment history, 35%. Amounts owed, 30%. That's a pretty good weighting as well. So I like to look at the largest weightings because if you focus on the largest weighting, then those are the things that are going to help you move your credit score. So it's the payment history, the amounts owed, and then the 15%, the length of credit history. So if you focus on those three things, that's 80% of your credit score. Those three things alone make up 80% of your credit score. Those three things alone. Candace is laughing because she knows I'm talking slow. Those three things alone make up 80% of your credit score. Can we have a microphone here for the question?
Please clarify on the length of credit history.
Sure. So the question was, please clarify the length of credit history. So basically, that is the history that you have, whether it's 6 months, whether it's 12 months, whether it's 18 months, whether it's 24 months, whether it's 10 years. Actually, 10 years is too long. Typically, about 48 months, 60 months is going to be the amount of history that you see on a typical credit report. Now, if you have some credit that's been out there for 75 months, then you'll see 75 months worth of history. So that length of credit history is a good thing because assuming you've made those payments on time, I should say, that is a good thing. Now, if you've got that same credit history but your payments have been late, then it's going to be a negative for you. But making payments on time over a long period of time is a good thing, and it positively impacts your credit score. So
Push back more on that point. If they don't go back to 10 years, do they?
No, not typically, no. Go ahead.
I was saying, how far back do they go?
Oh,
because
so-
I'm a senior citizen now.
Got you.
I've messed up.
So I've seen credit history go back 84 months, 86 months. Typically, 48 months of good history is really all you really need to have a good credit score, assuming all those payments are made on time. But typically, when you make a payment after a certain period of time, let's just say 60 months, then payments start to fall off, and you have more payments roll on, good payments, more new payments are added, and then the old payments tend to fall off. So if you've got 5 years worth of history, and that's the block of time or the window, then each time you make a payment, then one of the older payments will fall off of your credit report. It's still being tracked, but it's just going to fall off your credit report. So, but yeah, length of history is a good one. We get questions all the time about closing out accounts. Is it wise to close out an account? We always say it depends, but typically it's not wise to close out an account that has a lot of good history on it. Now, if it's an account that doesn't have good payment history, then yes, you probably want to close it out. It's not going to negatively impact you. But yeah, length of credit history, again, those three things, amounts owed, making payments on time, and the length of credit history, if you would focus on those three things, your credit score should improve. Should improve. Now, I say should, nothing's guaranteed, but because there are some really, really super unique situations out there where people can focus on these three things, but because of what's happened in the past, it's just going to take more time for the credit score to rise. All right, so there are a couple of other sections, credit mix, and then new credit, 10%. Again, I like to focus on the heaviest weighting because if you focus on those things will actually help improve your credit score. So 80% of your credit score are those three things. So if you ever wonder how important making payments on time are and how much you owe, amounts owed, those things are super duper important as well. Let me give you an example. So if you have a credit card that has a $5,000 balance, we recommend that you charge no more than about 30% of that credit card. So about roughly $1,500 charge up to $1,500, pay it down to zero. It's a $5,000 balance. You show the credit card company that you can manage that credit card. You're not maxing out the credit card and leaving it at $5,000, because when you do that, that hurts your credit score. It's almost like you have all this credit that you're not utilizing. So that's what the amounts owed, that 30% is. It's how you manage those credit, or the amount of credit that's extended to you. How you manage that is important. And that's what banks want to see, because they want to see a history of you making timely payments, you're advancing on your credit card, you're paying it off in full, you advance it back, you pay it off in full, you advance it back, you pay it off in full, and that revolving credit ends up helping your credit score increase. Yes, sir.
Curious. What if I won a lottery and put $1 million in my savings account? Are you saying credit really doesn't matter, keeping cash in your account, so long as you don't interact with the credit system?
So, so the question is, if you have a sizable amount that you want to put in an account, you probably think that you don't need credit. Well, you know, there are some things that even if you have the money, you might not want to spend your money. You might want to use the bank's money because you want to save your money or invest your money. We'll talk about investments in the next class. But for example, if you have $500,000 and you want to buy a house, is it wise for you to pay $500,000 and purchase that house and not rely on credit? Or is it maybe a little bit smarter to invest the $500,000 or spend $100,000, make the down payment on the house, finance the house over time so that you can invest the other $400,000 to hopefully make that $400,000 pot grow so that in the long run, you're better off. And so we recommend that you think about credit and borrowing money from the bank as leverage. Think about how can you leverage the bank? How can you use the bank's money to get ahead and then pay the bank back? And so there's a whole business cash flow cycle surrounding that, but on a personal level, it is how can you conserve your money, use the bank's money at a reasonable interest rate. There may be some tax advantages too. Candace can tell you about that. So there are benefits to not using cash and not relying on the credit system.
That's real good.
Candace?
That's actually great. And then, you know, I love the way that you put that credit is the management of debt, right? So if you use all cash and you don't use your credit, do you know you'll have a bad score, even though you don't have anything?
Right.
So that's a thing. Because credit is the management of debt. How do you manage the debt? Now, secondary, if you bought a car for $20,000 today, let's use an example. Cars are like expensive, so maybe I should say $30,000. Okay.
Or
so you
higher.
bought higher. Okay, right. You bought a car. Let's say it's $30,000 today, and you spent cash money. Boom. We together? We rolling? God forbid, but life happened, and some kid texting and driving runs you over and totals your car. My question to you, now you just bought this car today, and this happened tomorrow, God forbid, right? No, nobody in this room or anywhere, but just for the example, are they gonna give you $30,000 for that car? I'm sorry, what'd you say? Oh, okay. So would it have been smart in Marcus's example, like he says, you're gonna buy that house to spend all your cash. Would it have been smart to really spend $30,000 on that car? They ain't giving you that money back tomorrow, not you know, when you drove off the lot, honestly. So it's a thought process. You have to be smart with how you're leveraging cash. It's great to have it, but is that the best method? And if Marcus Nehmet Arvis was going to give you the same car for 3% interest, 6 these days, right? It's just really high. But you get my point. Or use my $30,000.
Right.
That I'm never going to get back, because even if something happened the next day, the next minute, as soon as I drove off the lot, are they going to give me that money back? You just have to look at how you leverage your funds.
Yep.
Yes, sir.
What if I paid for the insurance cash?
Because the vehicle is a depreciating asset. Like, it's good to have the vehicle, but as soon as you drove off the lot, it's no longer worth the same money that you paid for. So even if I paid cash for the insurance, are they going to say that vehicle values at that $30,000 that next day? Can't guarantee that.
Right.
It's likely no. Because they're selling us the vehicles. Remember, if you bought it for that much, they paid a bunch of people to have that transaction happen. That didn't mean the car was really worth that amount. They had to include all of the people they paid in there too. Finance companies, your salesmen, all of the people over the salesman. Is the car really worth that amount that you paid? Yeah. Oh, thoughts?
And we talk about, maybe spending your money on things will appreciate in value instead of things that depreciate in value. I never will forget, I was trying to trade a car in, and I go to the dealership, and they really hurt my feelings because I thought my car was worth a lot more than what they were telling me. I know. So they really hurt my feelings because I'm thinking, I've had this car for a long time. I've babied it. I've taken care of it. So it should be worth, X amount of dollars. Well, I rolled on the car lot, and he was like, okay, I'm going to give you Y for it. I'm like, wait a second. That doesn't seem fair. But my point is that things always seem to be more valuable to us because sometimes there's sentimental value, sometimes there's ownership value because we've owned something for a while, we've grown accustomed to it, we've grown attached to it. We think it's worth a lot more than it really is. But cars, actually, if you buy a car right now, tomorrow, try to take it back, they will not give you what you paid for it. Just one day, 24 hours. Don't care how many miles are on it, they're not going to offer you what you paid for it. They're not going to give you what you paid for it. It's a used car at that point, especially if you buy it new. And once you take it back, it's used. So we're just asking you to think about how to leverage the bank or credit union or finance companies to your benefit. I'm a banker. Yes, banks make money when they loan money, but we want you to be smart about it. And as I started out by saying that banks, they love to loan money out, but they love even more getting the money back. So we want to make sure that we loan money to folks with good credit risk, with a good credit profile, who have a history of paying their debts back and paying them back on time. So any other questions about this chart or about the FICO score? Candace, I don't know if there are any questions online, but we might check. Okay, so 80% of your credit score, these three things: payment history, okay, amounts owed, length of credit, it's going to get you there. It's going to help you increase your credit score. But let's look at some other things that impact your credit score. We talked about the credit utilization already, so if you have revolving credit, by the way, is credit that you have access to that a bank or a finance company will give you. Let's just say $5,000 on a credit card. And revolving credit is you draw money off of that credit card, you pay it back. The $5,000 becomes back available for you to use again, over and over again, once you pay it back. Revolving credit. Term debt are things like cars, mortgages, where you make a set monthly payment every month and the balance is decreasing, but it never rises again. So term debt is paid down. Revolving debt, you pay it down, but it's available for you to use over and over again. So credit utilization, we talked about that, 2 to 3 lines of credit. So you want to have different types of credit. You want to have, for example, a mortgage, an automobile loan, a couple of credit cards. So you have a different credit lines, a different mix of credit. You don't have just, all cars or all credit cards. So having 2 or 3 lines of credit, different types of credit, on-time payments is up here if you notice again. Long-standing credit history, we talked about that, length of credit, then a history of paid-off loans. So as you pay loans off, that history is going to benefit you, assuming that all those payments were made on time. I have to keep saying that because if you have 6 years of credit history, but they're all late payments, that's going to negatively impact your credit score. So, okay, so these things, they help your credit score, and FICO is really just a credit score. Yes.
Online, they just said,
You know, there's a definition for FICO. It's like for Isaac, something, something, but it's basically, it's your credit score. It makes up all these things that we're talking about right now. When you look at the credit mix, go back here to the little wheel chart, flywheel. So all these things go to make up your credit score. So FICO is just your credit score. And while we're talking about the credit score, if you pull a credit report from TransUnion, from Equifax, or from Experian, don't expect those numbers to be the same, because some of it's timing of when creditors report to the credit bureau. So it's common to have 3 different credit bureaus report your credit score, and the number may be 3 different numbers. Now, it should be within range. I mean, one's not gonna be 500 and the other 8. But I mean, it might be 800, might be 795, might be 799, but they'll generally be around the same range. But that's all the FICO score is. It's your credit score. Go back here. All right, so things that hurt your credit score. Credit lines maxed out. We talked a little bit about that already. So if you have a credit card that's $5,000, you don't want to max it out at $5,000 and leave it there, because that actually hurts your credit score. If you have too many credit cards, most likely you're just going to be paying the minimum payment, which might be $35, $40 a month, and it's going to take you forever to pay that card off. So we advise you to have 2, maybe 3 credit cards that you can pay off completely every month, and that's the key. So we are oftentimes asked, well, how many credit cards are too many? Well, it depends. There's not a set answer. It depends on the individual. But the idea is that if you can pay those credit cards off completely every month, that's the key. That's the goal. Other things that hurt your credit score, late payments, we talked about that, paying on or before the due date. No credit history at all. So when you're young and you're starting out, typically with high school and college kids, they're not going to have any credit. So you have to start somewhere, and we always recommend that maybe you start with a credit card, small credit card, and then just keep moving your way up. You can get someone nice enough to co-sign for you if you're young and have no credit, but we have a whole nother story about co-signing. Just know when you co-sign, you're actually a maker of the loan. So you're just as responsible for making the payments as a person that you're co-signing for. So just know that you are a joint borrower. So how they pay impacts your credit score. If they don't pay, it impacts your credit score. So we always advise extreme caution when you're co-signing for someone. I didn't say don't do it, but use extreme caution. And then the history of defaulted loans negatively impacts your credit score. Yes, sir.
Exactly at that point, history of paid off loans, is it a lifetime or against like credit score? Talking about 48 months.
Say the first part again, I'm
The
sorry.
history of paid off
Oh, the
loans.
history of paid off loans?
Suppose I paid off for 10 years, from 30 to 40, then things happened. And is that a consideration at all?
Assuming that the history's good and it's still hanging out there, it's not going to hurt you. But again, at some point, it's going to drop off. And so credit history doesn't stay forever. And so at some point, it's going to drop off. But it all depends on what your other mix is. I mean, if you've got 4 or 5 credit cards and you've got one that's been paid off for 10 years, at some point, it's going to drop off. But it's not going to hurt you, assuming that the payment history is positive and all payments have been made on time. Yeah. Okay, moving right along. So who can view your credit report? So car dealerships, financial institutions, insurance companies, credit card providers, employers. So if you apply for a loan with Arvest Bank, we're going to check your credit score, because obviously when you're working with money, we want to make sure that you can handle your own money before you start handling other people's money. So financial institutions, they like to pull a credit report on you to make sure that your management of your financial affairs is top notch. And then you. So annualcreditreport.com is a free website where you can order a free copy of your credit report. It doesn't cost you anything. Now, you won't have a score. They won't give you a score, but they can give, you'll get a free, complete copy of your full credit report by going to annualcreditreport.com. We encourage you to do that, take a look at it, and then maybe next week if you have questions, we'll show up a little bit early and try to answer any questions that you might have. But actually now, well, historically, you could only pull a copy of your credit report once a year, hence the name annualcreditreport.com. But now, they will allow you to pull it as often as you want. I mean, if you want to pull it weekly, you can. That's a change from the way it has been in the past. But that's a good thing because you can always keep up with your credit report history, make sure there's not any fraud. Now, pulling a report every week is probably a little bit too much, but if you wanted to, you could. But we actually, at a minimum, feel like you should pull your credit report once a year, maybe twice a year, just to make sure, depending on how much credit you have and how active your credit file is. So if you're selling cars or buying cars, purchasing cars, and purchasing things, then you might want to look at your credit report a couple of times a year, just to make sure that there's not any fraud or anything like that on your account. All right, I got a few more minutes, then we'll open it up for other questions. So if you're establishing credit, again, pretty much for our youngsters, they have to get started somewhere. Takes a little bit of time. Some key things I mentioned, the credit card, starting out with some small, credit card. It could be a $200 card that has $200 on the balance or availability, $300, something small, and then get them accustomed to, paying on time or auto debit, and get them into the habit of handling credit. But we say don't pay out the full balance until you receive your statement, and that's really just, sometimes there's some lag time towards the end of your statement cycle where you may, typically it's on a 30-day cycle. If you make a purchase on day 28, if you look at the system, it might show one balance, but it's not updated until you get your statement. And again, paying that statement off in full every month is the key, because it helps you to manage the account, but also the availability is on revolving debt. The availability is made available to you again, so that helps you as you pay the credit card off every month in full. And then on the very bottom it says in some situations, as we talked about, co-borrows may be necessary. Again, I stopped short of saying don't do it, but use extreme caution if you're going to co-sign, and just know that when you co-sign for someone, you are actually a joint borrower. Even though they get the money, you're a joint borrower. You're just as responsible as they are. All right, so types of credit, we talked a little bit about it. Installment credit, car loans, boats, unsecured loans. Sometimes if your credit history is strong enough, there's the opportunity to have an unsecured loan, mortgages, and then revolving credit, as I talked about. Credit cards primarily fall into that category. There is something called a home equity line of credit or a personal line of credit. And basically you're just using, on the home equity line of credit, your home is collateral, and you use the equity that you have built up in your home, and we'll make you a revolving line of credit based on that availability. There's a formula there, so it's not 100%, but there's an amount that the bank will loan you based on the equity that you have in your home. And personal lines of credit is just revolving line. It's much like a credit card, except it's we issue you checks so you can actually write checks. All right. Again, installment credit is where you get a lump sum. Revolving debt is where, we'll talk about it here in a minute, but installment debt, generally, you know, there's set monthly payments, as I mentioned before. We loan you a set amount, and as you pay it, the balance falls, and until you pay it off. And then revolving credit, again, debt can be accessed over and over again as you pay it down. So revolving credit gives you the greatest amount of flexibility. So if you have something a project that you want to do around the house, for example, and you want to use your home as collateral, let's just say you want to remodel your kitchen or bathroom, then you can use the equity in your home and get a revolving line of credit. Then as you pay the money back, it becomes available to you to use again. So next time you might want to remodel your bedroom or the master shower, whatever, or you might want to enclose the carport. So the most flexible type of loan is the revolving type of debt, because you have the opportunity to use the money over and over again as you pay it back. Yeah. All right, talked about home equity line earlier. Again, a good opportunity, a good way to remain flexible if you want to make large purchases, or if you just want to, you know, have a safety net. I mean, we've made home equity loans to customers who just want to invest the money. Let's just say that they have $50,000 in equity in their home and they want to invest it in something, and it's a good way to access the equity that you have in your home and give you some flexibility there as well. So. All right, we're nearing the end. We talked about kind of credit scores. Let's talk about credit monitoring. We live in a world where fraud is just running crazy. So if you don't have some type of credit monitoring on your account, we recommend that you do for not just peace of mind, but for monitoring. And there's some alerts that you can place on your credit report so that if someone accesses your credit, they have to call you, for example, so you can lock down your credit so that you know every time when someone is requesting credit, if it's not you. But we recommend some type of credit file monitoring, just because, again, fraud has been on the rise for the past decade, and so for safety, security, peace of mind, having some type of credit monitoring is generally a good idea. So, all right, right on time, 51 minutes. Question?
Okay, I have a question. The revolving credit and the home equity loan, is that the same thing, or is it two different things?
So they're essentially the same.
Okay.
So home equity loan, the collateral, what's securing the loan typically is the difference. So on a revolving loan like a credit card, it's unsecured. On a home equity loan, it's a revolving loan too, but your home is being used as collateral. And so a lot of times customers will exercise that option because there are some tax advantages when you use your home as collateral. Yeah. There's some tax benefits.
Okay.
And Candace can tell you all about those tax benefits, not me. I'm not the tax guy. She's the tax expert. Other questions? So our goal is for everyone to have a credit score that's 800 or higher. Okay? 800 or higher. That's the goal. Yes, ma'am.
This is probably false, but I've been seeing on the internet where you can use your home equity loan to pay off your house earlier. Is that true?
A home equity loan to pay off your house earlier.
They say get the home equity loan and then you put part of that onto your house principal and you pay it off and then keep on, and that somehow pays it off.
That's a new one on me. So Candace, have you heard of that one? Okay. So there's something floating around the internet where you can use a home equity loan to pay off your home faster.
Oh, yeah. Yeah, they're using what they call a HELOC, and you put it into a software program. They're taking all your debt. We're talking about your credit card, student loans, and everything, and they're rotating the money from the loan inside your bank account, and the software program is deciding what to pay first. So what happens when the small debt is paid off, they'll load up on the other debt you were using and accelerate the mortgage with excess money. It's a software program, but guess what? You can do it all on your own. Really easy.
Okay, so it's not just mortgage
No,
debt,
no,
it's all
But
debt.
what they do, they use the mortgage to create excess money to put inside your account. Then the software program start directing money out of your account to pay off the excess bills.
Okay.
To create a margin so you can create more money to accelerate your mortgage. But what I'm saying though, if you use our debt elimination program that we teach, you can do it on your own.
Yeah.
The average person can pay off their mortgage, student loans, credit cards, and everything in about 8 years if you use the proper program. I don't care how much you owe your mortgage. I don't care how many student loans you got. If you use that system, you can pay off your mortgage. 8 to 9 years, max, yeah.
Yeah. Thank you for the question.
Right.
So the snowball effect that we teach in this class is similar.
Absolutely. Snowball effect does the same thing. And of course, we'll teach you a couple of other strategies, you know. Go to a biweekly mortgage, which creates an extra payment per year, things of that nature. But with the snowball effect, we create the excess money. The excess money snowballs the principal of your mortgage. And most times you can pay it off between 8 and 9 years. Okay, good deal.
Okay.
All right.
Any other questions? So the last thing I wanted to talk about was the letter that I mentioned early on. So there is a dispute letter, and there's a sample that was placed on each table. And this is just a sample letter that you can write yourself to the credit bureau if there is something on your credit report that doesn't belong, or that is a mistake, or that you've taken care of. So if there was a collections, for example, let's just say it was $200 that someone placed on your credit report, some company did, some collection agency placed it on your credit report, and you've now paid it off, you can utilize this letter. This is a sample letter that you can use to write to the credit bureau with your documentation that you paid that collection off, and ask them to remove it. So we wanted to give you this sample letter so that everybody knows that there are companies out there that will charge you to do this, but you guys can do it yourselves. Doesn't cost you anything, free of charge, okay? All right, other questions? I'm about out of time, and I never want to stand in between anyone and dinner. So I think dinner is, I think dinner is about ready, Candace? Can I go ahead and pray us on in? Okay. All right. So if you'll bow with me, we'll go ahead and bless the food, and we'll start you through the line. So our Father which art in heaven, we thank you for another opportunity. We thank you for the simple things. Lord, we thank you for life. We thank you for the air that we breathe, Lord, the things that money can't buy. We really want to thank you for that. We appreciate that. Lord, we hope that the seeds that we've sown in the first half of this class, and as we will in the second half, fall on fertile ground. Lord, you said in your word that, you know, there's a planter, there's a harvester, but you're the only one who can give the increase. So we thank you for the increase in advance. Lord, we thank you for this food for nourishment of our bodies and the hands that prepared it. In Christ's name, amen. All right, let's eat.
All right, good. Now next week, you know, we got a big week next week. I'm gonna tell you, everybody gonna show up. You gonna bring your friends, your cousins, and everybody next week. It's the last class, right? And I got 2 reasons why you gotta be here. We should have been here this week, and when I'm talking to y'all know, so I ain't gotta tell y'all that. But the second thing, 2 things. The first thing is that we're talking investment stuff next week. Everybody, if you don't invest, you should be. If you don't know how, it's okay. Learn something. We'll talk about that next week. It's going to be great. Deacon Thomas is going to be featured in that class. It's going to be wonderful. First thing, if you don't come early, you likely won't like your seat because everybody will be here. I'm just telling you. Then number 2, we having some chicken. That smoked chicken from Sweet Papa's. It'd be so good. I think everybody come for the chicken because they know we do it in the third class. Everybody. But anyway, all right, here we go. We're gonna go ahead and get started. Have y'all enjoyed tonight so far? You learned some stuff about credit? Yes. Great. What is that top 80% that he talked about? He repeated like 3 times. This is your pop quiz. What? Payment history, amounts owed. And you just, okay, look at y'all. Okay, there you go. Marcus, you know they were listening. They got it. That's the key. Okay, so what we're going to do next, we're going to talk real estate. Jamil normally does this session. She's amazing. She's a realtor, but she said, you know, today I'm going to pass the torch because I ain't feeling my greatest and I can't give them half of me. I need to give them all of it. So she take a sick break today. It's her first time in, I think, 10 years ever missing her time to speak. So, you know, she's sick for real. But she didn't want to bring anything and spread it, you know, so that's respectful. So, Jamil, we miss you. We love you, but you sent KG, which is Corey Garrett, who is just as good, so we're going to have a great night. Corey is actually the only minority owner of a real estate company with Century 21. I might have messed it up, but it's a big deal. He owned the franchise. He's the only minority owner of the Century 21 franchise. That's a big deal, y'all. That's a big deal. And on top of that, it's housed out of Conway, even bigger deal, okay? Bigger deal, right? They're doing great things. They really help people in the process. And tonight, they're going to be giving information and education about real estate, owning versus renting, and all the great things that comes with it. So KG is what we call him, but his name is Corey Garrett. Come on up. And he happens to be in one of the greatest fraternities of all time, but Deacon Thomas would say something different. Omega Psi Phi frat brother, okay. Ooh. All right. Just kidding. Come on up. Y'all welcome KG. Corey Garrett.
Microphone check. Microphone check. Microphone check. 1, 2, Rick. Nah, I feel real important. I got one of these things on. How y'all doing? All right. So the good news is y'all stuck with me. But Jamil is a great presenter, and I'm gonna try to fill her shoes tonight. I will tell y'all. I noticed that y'all done had y'all dinner. I know that y'all done had dinner. After when y'all have your dinner, or something you don't want to talk long. I don't take long. All right. All right. Cool. So, left to right. All right. Cool. All right. So let's talk about real estate. Like Candace said, well, I'm Corey Garrett. I'm the principal broker of Century 21 Sandstone Real Estate Group. We started Sandstone Real Estate Group back in 2008. We started under a, well, really, I started in real estate back in 2006 under a gentleman by the name of Greg Hunt. He was my mentor, taught me everything that I needed to know about real estate. He actually sold my first house. And after he sold my first house, I was unemployed for a while, and so I decided to go start selling some real estate. He brought me in and taught me the game. Back in 2006, we were working for another company. And so we left out of that company in 2008, started our own company, Sandstone Real Estate Group. Only minority-owned company in Conway. At that time, Greg was the only African-American principal broker in the Fulton County Board of Realtors. He was the first African-American president of the Fulton County Board of Realtors. So we built a company and we ran with it up until 2015. I'll get back to the other stuff. And that's when Greg died from colon cancer. And so that's from that point on, it's been me as the principal broker and running the company. But back in 2011, I was recognized as under 40 by the Arkansas Business. And in 2012, we got to work with Salter Development, or Salter Construction, on a big housing development in Conway of about 60 houses, and they gave us our big boost. 2021, I had an opportunity to come to me, and I franchised the business, made the Century 21 Sandstone Real Estate Group, making me the only African-American in Arkansas to own any kind of real estate franchise. That's your Century 21s, your Remaxes, your Coldwell Bankers, or whatever. I'm the only one of us to own any kind of real estate franchise in Arkansas. Thank you. 2022, we was voted Small Business of the Year by the Small Business Administration, well, the Small Veteran-Owned Business. I'm a veteran as well. And in 2022, we was also awarded the Chamber Conway Small Business of the Year by the Chamber of Commerce. I'm also the immediate past president of the Conway Area Chamber of Commerce. I'll talk you'll hear a lot about Conway, but no, my office is in Conway. I have office in Little Rock too. I got agents. I have 27 agents. They're located in Little Rock, Conway, Greenbrier, Pine Bluff. I'm from Forest City. I work that area. Forest City in the house, yeah. All right. So, why invest in real estate? Why invest in real estate? It's a long-term savings plan, number one. You're talking about building generational wealth. Y'all have heard that term before, generational wealth, right? You know, so that's having something to pass on down to the next generation. Retirement. Let's just say you own you a couple of houses. You got some equity in those things, and you're needing to retire one day. You can always turn around and sell those things, take the equity out of them. Debt repayment. You own your house. You know you owe some debt. You can refinance that house, take the money out of there, pay your debt off. I had a lady she just closed last month on a house again for the second time. I've sold her 2 houses. The first time I sold her house, she got in there, had a couple of kids, racked up a whole bunch of debt. She called me, she said, hey, I need to sell the house, take the money out, pay some debt out, and I'm gonna start all over. So she sold that house. She went and stayed in an apartment for about 2 years, stacked her money back up. She turned around and then I sold her another house. So that was a way for her to get out of debt because she had a long-term savings plan, all right? And what are the benefits? You get tax benefits, of course. So you get that homestead tax credit every year, $350. Let's just say if you have to do some repairs to your properties, that's a loss. You can write that off on your taxes. But I won't get into all the tax stuff because y'all got the super tax person back there, Candace. Property value increases. Property value increases, and I'll talk about that in another slide, and I'll show you how properties have actually appreciated in Arkansas over the last few years. And it helps build a healthy economy. You think about it, where the people own houses, the schools are better, neighborhoods are better, the economy is better. So you think about it, people have a sense of ownership in their area. So you have that sense of ownership in that area, you're gonna take care of your stuff, hopefully your neighbors take care of their stuff. We build up the whole community together, all right? If y'all ever get any kind of questions or anything, y'all can just go ahead and blurt them out to me, all right? So here's what I'm talking about, the median home sales prices in Arkansas. So, back after COVID, I think the interest rates end up dropping to like 3 and 4%, stuff like that, right? And so in the business, I hear a lot of people say, man, when you gonna get off the fence? When you gonna buy your house? What you waiting on? Well, I'm waiting on the interest rates to drop again. They not dropping that low again. It's not gonna happen. And so while you're sitting there waiting on the interest rates to drop, look what's happening. In Arkansas in 2015, the average house sold for $160,000. Here we are today is $270,000, right? In the United States, the median price was $222,000. Today it's $436,000. So what I'm trying to tell you now is go on, get off the fence, right? Because buy low, sell high. That's the name of it, right? So if we got in 2015, we're Gucci now. We didn't, but we're gonna get in now, and we still gonna be straight because we talking about the price steady going up. And for God say don't own any land because we know the value of land does not depreciate. So if you got land, you got gold mine right there, all right? Cool. Any questions? No? All right, I'm boring y'all to death. Don't lie to me. I'm gonna take my glasses off. All right. So are you ready to buy real estate? Well, your lender gonna help you determine if you're ready to buy or not. You may say you're ready, but I heard them talking earlier about credit score. I think they're gonna talk to y'all about here if they already had talked to y'all about the monthly spending plan, all right? And then the big thing, like I said, we already talked about the credit. So the loan officer is gonna tell you what they're gonna do. They review your credit score, and they're gonna talk to you about your debt to income ratio, right? So we may make good money, but we got a whole bunch of debt, right? And so they're going to count that against you. I don't know what the equation is, but they have an equation that they work by, and there's a certain number. What's that number? What's considered a high DTI?
A high DTI is anything over 42%.
42%. So that's on the high end. There you go. So your DTI. So you may have something. You may say, man, I made good money, or I was in the Navy. I was in the Navy. I can get the VA loan. You go in there, you ain't gonna get that mug if your DTI messed up or your credit messed up. They say, well, I can get a guaranteed loan. Yeah, it's guaranteed by the government that if you don't pay it, the government pay it out, but it ain't guaranteed that they're gonna give you the money. All right? Building wealth through real estate. Primary home. So your primary home can be the one thing that you use to get this thing off the ground, right? You can use this primary loan, your primary home, because it's increasing in value, right? It's increasing in value, so you paying it down. You got your little equity over here, and you decide that, hey, I think I want to get into this old investing game. How am I get in there? Oh, I ain't got no money to put down. So what you do is you go pull your home equity line of credit on your personal house, then you turn around and invest it until you use that as your down payment for your new house, right? And so we get these investment properties over here. I buy this first investment property with this HELOC right here, get it fixed up. I got it running. I turn around and start gaining equity in this first house, in this house that I just bought. I got equity in this house that I just bought. I turn around, pull a HELOC on this house that I just bought and pull the equity out of this mug and turn around and buy the second house, right? You turn around and buy the second house, just say you good, you're fine. You turn around, you sell it, take the money from the HELOC, from the sale, put it back on your HELOC. You got your line of credit right back there ready to go again for your next product. All right? I know it all sounds kind of muddy, but you got people who are going to help you work through the thing. You got Candace back there, you got Deacon Thomas, and you got Brother Gwen from Marvis Bank. They help you work all through these things right here. There's ways to get these things done. I think what you all need to do is don't be afraid to ask the question, right? All right, because everything that I learned about trial and error, baby. All right. And some of the best lessons is about lesson. And I done paid for some. just so you know. All right, so well-chosen assets, right? Well-chosen assets. So make sure, let's ask questions. You got real estate agents and you got bankers in the room, you got accountants in the room. Is this going to be a smart money move for me?
Believe it or not, 2 days ago, was it on NPR, I appreciate and embrace the capitalist system. The argument being made was this kind of investment, they are trying to get a body to make sure folks like you don't buy property in a given community so that it's affordable. Have you heard that argument? And what do you say about it?
You know, I did not hear that on NPR radio, but I was looking on social media, and I have a cousin that stays in Baton Rouge, and he was talking about how all of these investors are coming in, buying up properties, and he didn't like it because it was making stuff, the people who needed the houses in the hood couldn't get them. But here's my take on that. It's the have versus the have-nots. And either you can buy or you're going to rent, right? So either you're going to get yourself in a position to where you can buy your own house or you're going to buy mine. I'm sorry. It's the truth of it, right? If you're paying rent and you are buying their house, right? I got a house in Hope. Bought it in a foreclosure, $40,000. It was a nice house. I hadn't done anything to the house. The lady standing there, she done paid it off. And I need the money right now. I got a relative that's in a situation with some health concerns, and he just happened to be my business partner, so I gave her a letter the other day, and I told her, hey, you're going to have to move. I'm finna turn around, flip the house, fix it up, and I'm going to turn around and sell it. It's just, when I was living with my mama, we was all settled in the house. We got a note one day. The lady said she wanted her house back. So it's cold, but I'm sorry. Yeah, but that's all right. We're going to get right. We're going to get right, and we're going to be the ones that's holding the bag, ain't we? We're going to be the one holding the bag. Ain't that right, Miss Nancy? That's right. We're going to be one holding the bag, ain't we? You already holding the bag. All right. Y'all give it up Miss Nancy. She got the bag. Miss Nancy, I ain't got no problem. I like it, Miss Nancy. I like it. All right. All right, so you got options. You got options in this thing. So you decide you want to, make your investment, whatever. We can flat out buy us a darn rental property. Buy us a rental property. Probably going to be about 15, 20% down is what I think they do on rental, on investment properties and what they do on land. You can piece up together and invest in a bigger real estate deal. I've taken on partners in certain deals. You know what I'm saying? I know somebody got good credit, know they got money, know they got a good business sense. We done business together before. We can team up on some things. Me and Candace, we teaming up on some things. I got a couple of partners that I team up with on some stuff. You got some family? Old Peanut, Pookie and them, they ain't gonna act right. They ain't gonna act right. All they gonna do is sit up under the shade tree and drink them 40s and you know what else. They ain't gonna get their credit right. They ain't gonna do right. They're not gonna ever buy a house. But they'll pay their rent. You know they pay their rent. So what? So what I'm gonna do? I'll buy a house. I'm gonna buy a house and I'm gonna turn around and I rent it to you. Might as well keep it in the family. All right? Yeah, keep it all in the family, baby. Yeah. Rent a portion of your house. Rent a portion of your existing home. Maybe you got maybe you got a basement. Maybe you got a house out back that operates as an efficiency suite or something like that. Then there's nothing wrong with, renting a portion of your house. Airbnb that sucker sometime if you want to. It's out there. Flipping houses, that's my thing. That's what I do. Buy low, sell high. I'm over in, when I go to my hometown, Ford City, people talk about my hometown. They talk about it because the houses over there dilapidated, then they falling in. And they say it's the ghetto. But when I go, I see money. Buy low, sell high. Buy low, sell high. I made a lady offer the other day, 2 houses. She want $4,000 for both of them. I told her I'd give her $2,500. I'm gonna turn around, put me some duplexes on them. All right? Then I'm gonna rent them suckers out for a minute. Then I'm gonna turn around and I'm gonna sell the duplexes. All right? Real estate investment trust, what happened with those things is to say you got a company, it's like a big conglomeration, and they own several houses. They own several houses, and what you do is in this real estate investment trust is you invest a portion of your money. It's almost like a 401k. They already got it already picked out for you, and you just invest your money, and you taking your chances on the company or the trust doing good. Any questions? Feel like I've been talking a long time. What's up, man?
What's the best way to get in flipping houses?
The best way to get into flipping houses is to, remember I told you earlier, the best lesson is about lesson, right? So you're gonna need to get you some help. What you need somebody out there. If you're a novice, you don't know what you're doing, you need an agent or somebody or a contractor, somebody that can help you find the deals, right? And then you have to be able to gather the comps on a certain area. When I say the comps, I'm talking about the comparables, because a house only sells for what the houses in the neighborhood around it sells for, right? So let's just say if you find you a good house in there, the bones of it look good. When I'm talking about the bones, I'm talking about the structure, you know what I'm saying? And you can get this sucker for $20 a square foot in a certain neighborhood, and you know that once you fix it up, it's gonna sell for $100 a square foot, then that may be a good investment for you. Now, one thing about fixing and flipping houses is you never know what you're gonna find when you go out there and rip out the walls and the floors and all that stuff. You never know. I done seen some stuff, boy, I done seen some rigging on some houses. How some people done put some stuff together. But that's your problem now, all right? Another thing I would say is about flipping houses is the property history, right? So we picked up some houses in the tax sale, right? So people don't see you don't pay your taxes, they come take your house, right? You gotta pay your house note and you gotta pay your property tax. Don't pay your property tax, they come take your house, all right? So we got the property tax and the house was in sale. We went and picked up the houses, but they end up having some liens attached to them, right? What I mean by liens is somebody may well put a roof on the house, they never paid the person put a mechanic's lien on it. That means that lien is now mine. So if I bought the house for $20,000, it got a $10,000 lien on it, that's my $10,000 lien. All right, come on.
I was looking at houses to buy for taxes. And what's the best way to find liens?
I think the best way to do that is to probably work with get you a relationship with a title company or an escrow company. And they'll probably want to charge you a fee or something to run a little property search to see exactly what's on the property's history. What else out there is there? Is there any websites or something that may tip us off to liens on property, anything? What is it? AR, do they record liens? The Commissioner of State Lands. Yeah, so if you do decide to go out to some of those tax sale properties, when you go to the Commissioner of State Lands website, they will have the liens that are, attached with the property.
Thank you.
Go ahead.
Whenever you decide to go that route, just be careful, because there's a process after you get that tax lien property. It's not just yours just because you bought it. It's yours at the time, but then, like he said, if there's a lien associated with it, you have to be careful to make sure that stuff is cleared, because now you just adopted a lien that came with it. On top of that, you want to make sure you go and quiet the title. Make sure that it fully becomes yours, because that's a part of the process after you purchase that property that you're referring to with tax liens. Be careful with that.
Good stuff there. Seek some help. Don't go out there trying to do it by yourself. For sale by if you starting out by yourself, I wouldn't do for sale by owner just starting out by myself. I would try to find me some help. As a matter of fact, let me go ahead and throw y'all another free one out there. So when you're out looking for these houses and stuff, and you go out and you see a sign in the yard, and it says Century 21. It says Century 21 Corey Garrett. I would love it for you to call me, because that means I'm going to make all the money. It's going to put me in a thing called dual agency. But what I advise you to do is, if you're going to call Century 21 and say Century 21 Corey Garrett, call Century 21 Jamil Rogers, or Jamil Thomas, I'm sorry, she's married now, and let her represent you, because that way you have your own representation, right? If you call that person on the sign, that means they're a dual agent. They're working for the seller, and they're working for you as well, all right? Not saying they're going to do anything bad. Realtors are tied by a code of ethics, but everybody doesn't always do the right thing, all right? All right.
So it's pretty safe to say that you need to partner with someone who knows what they're doing. So
Yes,
you
sir.
don't have to buy these lessons.
Yes, sir. Yes, sir. Best lesson is about lesson, and what you don't want to pay for one. I promise you don't, because it's been some deals that I done worked on, and it's tough when you sit there and you put all the work in, and then when you get done, you walk away with $2,000 when you thought you was gonna be walking away with about 20 or 30. It ain't no L, but it's a L in my book. Yeah. I ain't lying. All right, four ways real estate investors make money. We talking about the appreciation. I just showed you that the houses, they're appreciating. They show enough appreciation. Everything going up. Cash flow is income minus your expenses. So we always want to be getting more income than our darn expenses. We can also make some money in other ways. How can we make it? Application fee. You come to rent my house, I'm gonna charge you an application fee, $50. Late fee, $50. Every year, your rent increases by 2 or 3%. See what I'm saying? Or you come to renew your lease. There's a renewal fee for you to renew that lease. Yeah, there's all kind of ways to get money out here, and there's some people getting this money. It's like some people nodding their head like y'all done seen some of this stuff before, right? Yeah, I got an auntie that stay out there in Otter Creek right now. She done been in the rent house now for 10 years. She done got to the point they sent her a renewal the other day. It's done moved. I think when she first got there it was the 1100. Now it's all the way up to 1950. And she said, "I can't stay here no more. I bet you can." And she said, "Where I'm gonna go?" And she started looking around. She said, "Everything high." Y'all better get off that fence. All right. Oh, ancillary income. Shoot, have a darn washing machine, have a laundry service on site or something. You know what I'm saying? You come over there, you pay me for use my laundry machine and stuff. So it's all kind of ways to put it together and make money in real estate. All right. So we got us a little sales history on this property. 520 North Tyler, 3-bedroom, 2-bath, 1,400 square feet, built in 1950. 1989, that sucker sold for $57,000. Here we are, well, 2025, they turned around and sold them up for $277,400. $277,400. Just like that. $220,000, that thing appreciated. Where North Tyler at? Where's that? It's up in the Heights. Oh, okay. Well, anyway, appreciation. Look at it. Yeah. And sometimes if you want to, like me, I'm a real estate nerd. Sometimes I go on to arcountydata.com. It's free information. You know, real estate agents, we spies too. We investigate. So we can go in there and figure out how much they paid for it, everything. I'm going to tell you something. I'll tell you another secret. Some people be lying to me like they own the house. I go look it up and find out that they rent too. So I'm an investigator. I'm an investigator too. I got to investigate, see what's going on. No, I'm just messing with you. Yeah, but okay, well, that's what I'm talking about, the appreciation right there. Yeah. So you just think about it. If you bought that sucker in 57, you turn around and sold in 25, you straight. Oh, this old burnt-out Betty right here. I don't know where Jamil found old burnt-out Betty, and she the one gave it that name. That wasn't me. Burnt-out Betty. So this person found this burnt-out house here. So some people see trash. I see money, right? All right. So they purchased this thing for $15,000, $10 a square foot. You hear me, homeboy? $10 a square foot, 3-bedroom, 2-bath, 1,506 square feet. It was burnt out. They put $60,000 into it, turned around and sold it for $195,000. That was $105 a square foot. See, but what they did was they added another bedroom and bath and increased the square footage. If you can increase the square footage, it's always good that you can increase the square footage because that mean more money. Now, let me tell you this before I lose it, homeboy. If you mess around and lose square footage, then that's gonna hurt you. I'd had some clients I'd had some people under contract for a certain amount of money, then the appraiser go out and measure their house. If it's not the size that they say it was, then the square footage lower, that mean that price gotta come down. All right, what's up, man?
What's the typical interest rate on a project like this for loans?
Well, now you got your banking man over here now, but I'm gonna let him answer that. But the interest rate goes with the market. Using on investment properties, the interest rate is usually about 1 point higher than what the current rate is.
Generally, yes. Right now, rates are running about 7.25, maybe, depending on, all the other metrics.
That's investment property, right? That's investment property. So it's usually gonna be a little tick higher. And these investment properties, they don't work like a 30-year mortgage. You know that, right? Okay. All right, cool. So we got us a $110,000 profit here on old burnout Betty. Yes, ma'am. Yes, sir.
I'm not a real estate dealer, but when I looked at that house, I would rather build a new one. What goes behind the decision to flip and the decision to demolish and build some new structure?
Now that I don't know, because I didn't put this slide together. So I don't know why Jamil chose this one, you know what I'm saying? But I can just about guess that looking at the comps, if this sucker comping out for $10 a square foot, if I can get it for $10 a square foot, and I know I can sell it for $105 a square foot in this neighborhood, then that's about what did it.
So can it cost more to rebuild a property, right? So if I have that structure there, depending on what's going on in it, this property likely was cheaper to just tear out the bad stuff and put in new stuff versus to tear out all of everything and start all the way over.
And try to build a total new construction house, yes, ma'am. Because new construction these days going for about $170, $200 something a square foot.
Right, but you got to build that. But then on top of that, though, when you think about it, if my comps in that area aren't going to support that new construction, why would I do it instead of just taking out the old and putting in something?
Exactly. You don't want to have the most expensive house in the neighborhood
That you can't sell because ain't nobody going to buy it over there.
Exactly.
So you got the location is also important.
If you come in and if you build this house for $150 a square foot, and when you get ready to sell it, if them houses over there ain't selling for nothing but $105 a square foot, then that's all you're gonna be getting offered is $105 a square foot, unless you find somebody come walking up in there with you ain't got no agent and they're not advising you. No, I'm just lying. They're gonna do it in the appraisal. The bank gonna do it in the appraisal on anyway. It's not gonna appraise. The whole deal probably end up falling apart. What's up, Coco?
Question. So is there a difference in like rules and regulations compared to rebuilding a structure versus a whole new construction?
Rules and regulations as far as who?
Like as far as like building code and stuff like that. Like does that affect the decision on which route you take?
I would say no, because if you're gonna have to pull a permit, you're gonna have to pull a permit anyway. If you gotta pull a permit for electricity or plumbing, you're gonna have to pull it either way, whether you're flipping or doing new construction. Yeah. Could there be some, what am I trying to say? Some covenants and restrictions in a certain area that may not allow you to put on there what you want to put on there. Or you may be in a historic district, and they say when you get ready to do this flip, you got to put these kind of windows in there. We don't want you to do that. That's why you see a lot of investors really try to stay out of those historic districts, because they try to make you do those historical things that cost you a little more money. What's up, man?
How much income per year would you need to qualify for a project like this?
Sir,
I'm sorry, I didn't hear the question, sorry.
How mu-
It depends, because what we do is we take a look at your total debt and your total income today. We look at what you're trying to do and see if it makes sense, and if the numbers work out. There's no set amount. It varies by individual borrower.
They got a couple of formulas that they use over there, but that credit and that DTI, that's gonna be a big one. I will tell you in the investment realm, but dealing with these bankers, you're dealing with these commercial bankers. It's all about relationship, right? So
true.
you got to build a relationship with this person. Once they get to knowing you, they know that you pay your bills on time. They ain't got to run down and chase you. They're more likely to do business with you. Anybody else? I'm glad y'all asked me some questions. Shoot. All right. Oh yeah. So this is the lady that was supposed to be with y'all today, Miss Jamil Thomas. She married to him. No. But she's a real hoop. She's fun. That's my executive broker. That's one of my day ones. One of the first agents I hired back in 2008. She was a school teacher. She has now retired from teaching school, and she sells real estate full time. Yeah, I got two of them like that. So that's my day one. She's very knowledgeable. Let me get back up to her contact information. Can I get back to her again? No, hold on. All right, do me a favor right quick while I'm trying to get this back up. Get your phone out. Y'all get your phone out. Who on Facebook? Y'all on Facebook? Y'all go in there and send me a friend request. I have some good stuff on there sometimes. Sometimes I be clowning. One time I was, who was I? Who was I, Coco? I was MC Hammer one time. I was Kung Fu KG. I've been making some commercials. But if y'all need help with this real estate stuff, y'all got my card. I'll be glad to talk to you. I'm glad to answer any questions. As you can see, I'm also a general contractor, and I also own a property management company. So if y'all start buying some of these investment properties and y'all don't want to manage them yourself, holler at me. I got a team to do that too. I keep on going past it. Oh yeah, look me up, Corey Garrett, KORRY GARRETT. Send me a friend request. And then on Instagram, I'm real estate KG. Any house, anywhere, Miss Jamil can help you with it. So if y'all do me a favor, call her first. Call her first. Don't call the person, call her first. Call her first. All right, how can I help you?
What percentage do most companies that's going to manage a rental property, how much do they charge on the percentage of your?
Could you repeat the question, please?
When you're doing property management, if you're going to do property management, about what's the percentage that the property management company usually charges to manage your property? It's 10% of the monthly rent. 10% of the monthly rent, yes, ma'am.
I actually have two questions. My first question is, towards the beginning, you were talking about buying power on the slide, and if your buying power is like 200,000 or lower, what are some, and you don't want to dabble really or have a fixer upper, what are some ways that you can increase your buying power, or what are some other routes that you can go if you really don't want to have to fix up a house too much?
Okay, I'm gonna let him answer the question about buying power, but I'm gonna give you my little spiel first. Price, location, condition.
Okay.
That's when you buying a house. Those are three things you're looking for. I want it in price, the location I want it, and the condition. Out of those three things, you're probably only gonna get two of them. So you need to figure out which two are most important to you. If your $200,000 ain't working here in Little Rock, you may need to take it out to Bigelow. I'm just messing with you. I'm just messing with you. Go ahead.
So again, the buying power, it depends. So one of the things we want to see as a banker is a primary source of repayment, a secondary source of repayment, and then a tertiary source or third source. Typically, the third source is the liquidation of the collateral, which we don't want to get there. So the primary source of repayment is going to be, what is your primary source of income? And so, depending on what your plans are for the house, if you're buying to flip and sell, or if you're buying to rent it, we can count the rental income or the proposed rental income into your cash flow as well. But it depends. It's a lot more complicated than that, but you just need to really sit down with the banker and talk it through.
And I think another thing that I would say is to increase your income and decrease your debts. That'll help as well.
Okay. My second question is, I saw on the other slide you said, not on the other slide, you mentioned it. You said that the interest rate is higher for an investment property than it is for a property on land. Why is that?
The interest rate is higher for a investment property versus a what?
You said a land property.
Okay, versus your primary residence.
Yes.
I don't know why that is. That's a banking thing, but it's just all they usually go higher on investment stuff for some reason.
Yeah, part of it is the risk. So
yeah, the risk.
A lot of people, we all need a place to stay. So typically, if you buy a personal residence and you finance it over 30 years, a lot can happen before you actually leave the property or consider leaving the property. But on investment property, there are a lot of things that can go wrong. Like Corey said, you buy a house that on the outside looks like it's got good bones, but you might find that the elevation in one room is off or higher than the other, or there's a plumbing issue, or there's a roof issue. And so when you're buying houses and fixing them up, there are some additional risk involved, and sometimes you don't find those out until you get into the construction project.
Yeah, and your tenant is a risk as well. So you got your tenant in there, your tenant not paying you your rent. The bank don't want you to roll up there and say, well, my tenant ain't paid me this month, so I can't pay you. So that's why they charge you a little higher fee extra, so they can make sure that they covered. Yes, sir.
What is the best method of acquiring houses?
The best method of what?
The best method of acquiring houses
To flip? I think it's having a team working for you. Somebody like, one of my agents out there spotting them for you. Arkansas getting real big now on wholesaling too. But I hadn't done, the wholesaling thing. And then, you can do it yourself. You got the MLS system, the multiple list system is where the realtors pull all of their information from. That same multiple list system feeds Zillow, Realtor.com, Trulia, all of those other areas. So in order for that information to get there, it's got to be a real estate agent that puts it there. Another thing you can do is you can just ride around. You can ride around and look for the houses. It's easy to spot distressed properties. You can tell when they're not taking care of the property, grass grown up, they ain't been there 2 or 3 days. They may have a car sitting out there to make you think somebody's staying there, but the car ain't moved. And so those are people you need to be going to the AR County data, finding out who's where's the person that's paying the tax bill. It's not gonna be the first person name listed on there. It'll be a name down there say bill 2, and that's where the bill going. Like in Forest City, where I'm from, a bunch of those people, where the bill going to now, they're going out to California, Detroit, and I call them up. They say, "Oh no, that's my mama, dad, and I ain't never coming back though." So, what's up?
Because sometimes it feels like I want to do it myself because I don't want to pay nobody. So what's the average price point for a realtor to start looking and to work with you as it relates to a flip or just buying a property in general? Like, it doesn't have to be a flip, but what's the average price point or percentage on that?
Zero to about $1,000. Okay. A realtor may want to. Some of them may do it for you for free. Just because you walk in there with a pre-approval letter showing that you're good to go. Someone may want to sign you up to an exclusive buyer's agreement and get something from you on the front end before they start doing all the work, just to make sure that you're serious. But it's let's just say if you're buying a property, we recently just had, and I don't know if this is where you was going, We recently just had this big thing come down through the National Association of Realtors, I want to say maybe about a year or two ago, about commissions, right? So the way commissions used to be set up was you say, you hit me up, you say, hey, KG, I want to sell my house. Miss Lexi said, KG, I want to sell my house. I'm gonna come out to your house. I'm gonna say, Miss Lexi, I'm gonna sell your house for you. I'm gonna list it for you for 6%. I'm gonna take 3.6% for my company, and the person that bring the buyer, we're gonna give them 2.4%. You say, okay, fine, cool. Sign it up. I go put it in the MLS system, and whenever a buyer's agent comes along and they looking in the MLS system, they already know that they're making 2.4%, right? So somebody sued the National Association of Realtors, said that realtors was price fixing, and we shouldn't be setting buyer's agent fees, right? So now the way the game goes is you call me, you say, hey, KG, I want to list my house. I'm going to come out there and say, Ms. Lex, I'm going to list your house for you for 4%. Now, you got the right to pay a buyer's agent if you want to or not. You say, how much I usually pay them? I say, well, usually it's probably about 2%. Well, why would I want to do that? Well, you want to do that because 9 times out of 10, people just starting out, a lot of people money tight. They just barely got enough money for their down payment. They ain't got enough money to pay an agent too. And so what happens is if you're not offering a buyer's agent fee, you get passed over by buyers because they don't have the money to pay their own agent, right? So it's just say you may get in a situation where the seller say, I ain't paying no buyer's agent. I'm not doing it. So that means you got to come up with your 3 to 5% down payment or your 20% down payment on your rental property. Then you got to come up with your other 2 to 3% to pay your agent as well. All right? What's up? Did I get it?
No, that's good. That's
Okay.
good. The reason I ask is because whenever you start getting into buying and finding properties, especially when you're using Zillow, I like Realtor better because it's more up to date. Personal preference, right? But you get on there and you start sending messages and doing that, and now you get all these spam calls,
Yep.
right? You got to be careful with that. But if I had Jamil on my team, which Jamil is amazing, we on the same team, right?
Yeah.
And so whenever Jamil is there and I'm like, hey, this is the property that I'm looking at, and we have an agreement in place, she's gonna work for me. Not only am I looking for properties now, she knows my criteria. She's asking me questions. Hey, Candace, what are you looking for? How many bedroom? How many bath? You want to fix it up? No. Okay, well, we looking for something that's going to be a little higher price. She knows and she looks at it. And then now, not only am I looking, somebody's looking for me, right? And so now I have a team, and when I'm sleeping, she's up and she's looking. Right, and so I encourage you to hire someone to help, especially when you're first getting started, because you don't really know what you don't really know, right? Does that make sense? You don't know what you don't know. And so if you want to spend less money, hire somebody, and then after you hire someone, you pay for that, and that's okay. And then now you grow and learn as you go. I don't go into an agreement. I've been doing it a long time, right, KG? We've been hanging out a long time. I don't go into an agreement without it because I don't have time to go look up the stuff that Jamil gonna look up. And then she looking up everybody dead folks and who did this, and they going through a divorce, so they might take a little less. Like she has a whole process, and I don't have time for that. So let her be the expert and now in her field, and I'm gonna hire her to do that job. Does that make sense? So y'all just be careful with that.
Relationship. You go on Zillow and you get to clicking real estate. Zillow and Realtor.com, they have their own agents on there. So you mess around and say, click for more information. Then you clicking and you getting somebody that you don't have any relationship with. They don't have any. A lot of them don't even have local knowledge of the local market. So you mess around and end up having yourself in this situation. What's up, homeboy?
Is it true that you can make money off of getting houses under contract and selling the contract to a real estate broker? That's
the wholesaling. That's the wholesaling thing I was talking to you about. And so what happens is you get somebody like you, Nick. You say you a wholesaler. You go knock on somebody's door and you find out they want to sell a house, and then you write the offer up as Nick Construction or assignee. Then you run off and then you find a buyer for that house and sign that contract to them. That's what wholesaling is. But as far as me, you're not gonna be able to bring me a wholesale deal. I'm gonna go out and I'm gonna find my own and make my own money, right? So, what's up, Coco?
Last question. and I'll just say I agree. Call Jamil first,
Yeah,
cause she good and she my wife.
yeah.
But I want to ask you, what if somebody wants to become a realtor? Like, what does that process look like? What kind of financial investment is that?
All right. So you say if you want to become a realtor, it's just got to the point now where you can do this. You can do it online. It used to be go to class, sit in the classroom for either 2 weeks or 3 weekends. One website you can check out is WeTeachRealEstate.com. WeTeachRealEstate.com. Costs you about 60 classroom hours. The lady that owned that company is actually one of my executive brokers. Her name is Stephanie. Her location is downtown. She can either do it. You can go sit in the class, or you can do the virtual route. 60 hours. The class is gonna cost you about $350. Once you pass the class, you go sit for your exam. That's gonna cost you about $75. Well, hold on, let me back up. Before you take the exam, you gotta get the background checks done and get your fingerprints done. That's gonna cost you about another $75. And then you go sit for your exam, $75. Once you pass the exam, you sign on with a broker. You cannot work up under your own authority. You gotta work for a broker. That's when you call me. You say, hey, KG, I got my real estate license. You come over there, and I'm gonna let Jamil interview you. And I'm gonna let Jamil interview you. She gonna say, yeah, I think he got it. And then that way you're in, and then you start your training. So it's people say the test is hard. I passed it my first time. So I've seen some people struggle on that mug too. I don't claim to be the brightest bulb in the box either. I promise you I don't. But I passed the first time. That means y'all can too. Did that answer your question, Coco? 60 classroom hours. WeTeachRealEstate.com or RealEstateExpress.com. Real Estate Express, just like I said, it double up on the E's between estate and express. RealEstateExpress.com. You're looking for the 60-hour pre-licensing course is what you're looking for. Once you've been a real estate agent for 2 years, then you can apply to be a broker. All right.
All right, this is good. One other question there, and we want to respect everybody's time, so let's keep it.
Ma'am?
Red tag houses.
Red tag houses?
There's one in my neighborhood.
Okay.
And I would love to have that house. It was an old lady that died and no one lived there for 3 years.
Okay.
And it's all grown up.
Okay.
But I used to run and play in that house. I want that house. How do I get that house?
Okay. You got my card, right?
Yeah,
Okay.
I do.
All right. So if you would, that number on that 269 number 0999, if you would text me the address and let me get the history on it for you. If you go ahead and text me now or tomorrow, I'll make sure I get it for you tomorrow. And then I can find out what's going on with it. You gotta know what? You gotta know the address? Yeah. All right. That 269-0999, that's my cell phone number. If you give me the address, I'll get you the information. And that's how we do it right there, Nick. Just like this. Boom. Oh, you want your microphone back?
Mr. KJ, come up here for a second. Now, the gentleman in the purple shirt, what's his name?
That's Brimley.
Brimley, come on up here for a second.
Jamie.
All right, good deal. All these are Greek men. He is too. Which one? What are you, brother?
Yeah, Captain.
Come on up here. Come on up here. Come on up here. Come on up here. Yeah, by the way, make sure y'all get y'all Charles Schwab account set up for class next week, okay? Come on here, boy. Come on here. Charles Schwab account, be free. Everybody take your hands and push them this way, okay? Point to them this way. Y'all ready? Bow your heads. Father, forgive them for what they they don't know what they do.
Well, I can't believe you brought me up here for that.
Kappa, Q, Kappa. And I'm like alpha man. Great job.
Bless you, you got me.
Hey, listen, definitely for next week, go ahead and go online and get your Charles Schwab accounts set up. They're free. The three things I want you to watch though when you set your accounts up. If it asks you want a margin account, say no. Do you have anybody inside the securities industry that you're doing business with, or a family member? Say no. Those are the major two things. When you go in, just set up a brokerage account. It's not a Roth IRA account. It's not an IRA account. Just a regular brokerage account. Now, if you have a problem, dial at 1-800 and walk you through it. Okay. That's all I really have in the back of the book. We got some things that I want you to learn. In the very back, it's got those questions. What is a mutual fund? What is a stock? All that kind of stuff. I want you to be familiar with some of that stuff. Okay. It's going to be a fast-moving class next week. 2 hours. It's going to be get in, get out. We're going to jump right in and get started. So have those accounts set up. Kenneth, back to you. Let's pray. Everybody bow their heads. Father God, thank you for your grace. Father, thank you for your mercy. Thank you for your unmerited favor, Father. Thank you for this fellowship. Thank you for all the instructors you blessed us to listen to, Father, over the last couple of weeks. Father, we pray that everything that these people left this morning from their homes is in place when they get back. We ask that they learn something and share, Father. Teach one, each one, reach one. Those blessings, Father, in your Son, Jesus' name. Amen.